One of the easiest ways you can invest is by investing in Singapore ETFs. They are cheap, diversified, and have lower risk as compared to investing into an individual stock. But with 60 ETFs in the Singapore market, which ETF should you go for? Luckily, not too long ago, SGX published the top 10 most traded ETF for the first half of 2022. So, in this video, we will be going through each of the ETFs and I'll be ranking them based on how good I think they are. Alright, let's jump right in. First up on this list, we have the SPDR Gold Shares ETF. As you might have guessed from the name, this ETF tracks the price of gold. The 10-year annualized return on this ETF is nothing fantastic, giving only 0.99% a year. Then you'll be like, "Che, my bank is now easily giving 3 to 4% interest lah." But that's not the main reason why people invest in gold. Instead, gold has been traditionally known to be a good asset class to hedge against inflation. So, for example, while the US dollar depreciates over time, gold has held its value very well. Not only that, many people treat gold as a safe haven. So, whenever the market booms and crashes, gold would usually do well. So, rather than buying physical gold, this gold ETF gives you a good alternative of investing into gold. It has a low expense ratio of 0.4% and high trading volume so that you can buy and sell at a good spread. Though, because there's not much growth potential here and timing the market may be hard with gold, I will rank this as D. It's only good for those who are an expert in investing. But for the rest, this ETF doesn't have much use. Next, Straits Times ETF. There are two ETFs on this list that track the exact same thing. SPDR Straits Times Index ETF and NikkoAm Singapore STI ETF. Both of them track the 30 largest companies listed in the Singapore market, like DBS, OCBC, UOB, Singtel, and CapitaLand. Unsurprisingly, with Singapore being the leading financial center in the Asia Pacific, almost 50% of the holdings are in the financial sector, followed by 20% in real estate and 14.5% in industrials. SPDR STI ETF was listed back in 2002, while NikkoAm Singapore STI ETF came out a little later in 2009. So naturally, SPDR STI ETF has a much bigger fund size of $1.5 billion, while NikkoAm has less than half the amount. Both ETFs are similar in a lot of ways. Both of them gave 3% 10 years annualized returns, 3.75% dividend yield, and they even have the same expense ratio of 0.3%. So, it doesn't matter which ETF you go for, as you will achieve more or less the same results. For this ETF, I will rank it as A. If you are new to investing, STI ETF is definitely a good ETF to start with. Many of the holdings on this list are good companies and it pays out a healthy dividend yield. The only downside is that there's not many growth companies in this ETF. So, don't expect to get rich from this ETF, yeah? Next, Lion-OCBC Securities Hang Seng Tech ETF. This ETF tracks the 30 largest tech team companies listed on the Hong Kong Stock Exchange. These companies are related to tech teams in some way or another, like cloud, digital, e-commerce, fintech, internet, and autonomous. Top holdings include Kuaishou, Tencent, Meituan, Alibaba, JD.com, and each stock has a maximum weighting of 8%. As expected, 77% of the holdings are in the IT sector, followed by 9% in consumer discretionary and 8% in healthcare. This ETF just came out in December 2020, so there's not much data yet. But if you check out similar tech ETFs such as KWEB and CQQQ, they've given about 3 to 5% 10 years annualized return. For ranking, I will put it as C. Tech is a sector that can give high growth, high return. But China stocks carry political risk because the government can suddenly do stuff like policy changes and regulatory crackdowns, which can affect the stock market's performance. Quick pause. With Mumu, you can now check out your favorite company's latest earnings results, revenue breakdown, operating data, and some key financial numbers. There's even a section which shows analysis of the company, like what's the consensus rating, target price, and some detailed ratings by famous analysts. So, because Moomoo is celebrating Singapore's 58th National Day, they have a deal for both new and existing users. They are currently offering a fantastic 5.8% guaranteed yield for a maximum of 80k for 30 days. To get the deal, tap on Me, Promotions, look for the 5.8% guaranteed returns deal. Then tap Claim Rewards to start the deal. As a bonus, if you sign up with my link down below, deposit $100 and perform one buy trade, you will earn a $20 cash coupon. And 2, when you deposit $3,000, make 3 buy trades and keep the money in your account for 30 days, you will receive 1 free C Limited stock worth around $80. And 3rd, if you deposit a total of $10,000, perform 5 buy trades and hold for 30 days, you will earn another free Apple stock worth around $240. So if you are interested, you can sign up to Moomoo using my link down below. With that being said, let's get back to the video. Next up, ICBC, CSOP, FTSE, Chinese Government Bond ETF. CB long names here. This ETF tracks the performance of the Chinese Government Bond Index. 34% of the holdings are bonds with 0 to 3 year maturity, 33% with 5 to 10 year maturity, 20% in 3 to 5 year maturity, and the rest have more than 10 year maturity. This ETF is quite new, so there's not much data yet. But if you check the Chinese Government Bond Index, it has given about 2.4% annualized return since inception, which is what you would usually expect with a bond index. As for dividend yield, currently it's giving about 3% yield. I will give this ETF a C ranking. Obviously, there's not much growth here, but this ETF is good if you want to diversify your holdings into Chinese bonds, because Chinese bonds move very differently as compared to Singapore bonds or US bonds. The next ETF is iShares USD Asia High Yield Bond Index ETF. This ETF tracks bonds that are issued by Asian governments and Asian domiciled companies. So if you look at the holdings, the top issuers are Industrial and Commercial Bank of China, Seng China Limited, Country Garden Holdings, Win Macau, and even the Sri Lanka government. 27% of the bonds are from China, 17% from India, 15% from Macau, and the rest are from all over Asia. The bonds are also from many different sectors like financial, gaming, banking, and government bonds. But what does its performance look like? Since inception, it has given about 2.9% annualized return and is currently giving a super high 7.9% dividend yield. For this ETF, I will rank it as E because even though it has such a high yield, it is not stable at all. If I want to invest into bond ETFs, I will need it to be stable. Otherwise, it will be pointless to own that ETF. Next up, NikkoAm-Straits Trading Asia ex-Japan REIT ETF. This is also another ETF that's CB long names here. This ETF invests in REITs from all over Asia, except Japan. It'd be like, Japan, I don't want friend you. Just kidding. The reason Japan is excluded from these ETFs is because Japan is a highly developed economy, while the rest of the Asian countries are considered emerging markets. So there's no boycott thing going on, yeah. Most of the top holdings are your usual Singapore REITs, like CapitaLand, Ascendas REIT, CICT, Mapletree Logistics, Mapletree Industrial, and so on. 71% of the holdings are from Singapore, 14% Hong Kong, 5% India. As for sector allocation, 35% are retail REITs, 30% industrial REITs, and 13% office REITs. But what about the performance? Since inception in 2017, this ETF has an annualized return of 3.07%. The performance includes reinvested dividends. But if we just look at the dividend yield, this ETF currently has a 5.3% dividend yield, which is paid out every quarter. For this ETF, I will rank it as B. The return is nothing fantastic, but the whole reason we are investing into REITs is to earn passive income, which is what this ETF provides very well. There will also be capital growth as the companies slowly grow and expand over the long term. Next, we have Lion-Phillip S-REIT ETF. While the previous ETF tracks REITs from all over Asia, this ETF only tracks REITs from Singapore. So you have REITs like Frasers Standard Point Trust, Mapletree Industrial Trust, CICT, and so on. 37% of the REITs are in industrial, 26% retail, and 10% office. As for performance, this ETF gave a 3.5% annualized return since inception and currently has a 4.8% dividend yield. I will also rank this ETF as B. This REIT ETF is good for people who want to invest only into Singapore REITs but don't want to spend time researching and studying every single REIT out there. The ETF be like, you won't buy the wrong REIT if you are buying everything. Next up, SPDR S&P 500 ETF. This ETF lets you invest in the top 500 companies in the US. So the companies are your usual big companies like Apple, Microsoft, Amazon, Nvidia, and of course, Tesla. 26% of the holdings are in tech, 14% in healthcare, and 12% in financials. And you know this ETF is a good ETF because it has the seal of approval from the god of investing himself, Buffett Gong Gong. But there's one big problem with this ETF. The average trading volume of this ETF is 252, meaning there's barely anyone trading it. If we compare this ETF to VOO, which is also another S&P 500 ETF, but has over 91 million daily volume, the bid-ask spread is only 1 cent wide, while SPDR S&P 500 ETF spread is over $22 wide. As a result, you will lose a lot of money when buying and selling because of the wide bid-ask spread. So I will rank this ETF as E. There's totally no reason to invest in this ETF when there are a lot of better S&P 500 ETFs out there. Then you might ask, what about SRS and CPF? For that, you can easily use robo-advisors like Endowers to invest in the Lion Global Infinity US S&P 500 Stock Index Fund. So again, don't invest in the SPDR S&P 500 ETF because the volume is super bad. The last ETF on this list is NikkoAm-SGD Investment Grade Corporate Bond ETF. This ETF tracks non-government investment grade bonds. So there's DBS bonds, Temasek bonds, HSBC bonds, UOB bonds. 28% of the holdings are in sovereign bonds, 27% in banks, and 9% in investment companies. This ETF has around 0.7% annualized return since inception and currently has a 3% dividend yield. The yield is definitely not as high as iShares USD Asia High Yield Bond Index ETF, which is giving over 7% yield. But this ETF is a lot more stable, yeah? So for ranking, I will put it as C, right beside the Chinese government bond ETF. And there you have it. Those are the top 10 most traded ETFs for the first half of 2022. If you have any questions, you can join my fast-growing Telegram group to ask me or the members any questions that you may have. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.